Good morning, everyone. You're watching a live market outlook for Tuesday, 17th of January 2012. Strong appetite for riskier assets came out during the Asian session after weaker than expected data from China showed that China's economy grew at its weakest pace in past 2.5 years in the latest quarter, and it appeared headed for an even sharper slowdown in the coming months as export demand fades and the housing market falters. This triggered the stronger recovery of the euro-dollar after suffering heavy losses last Friday on the S&P's downgrading credit rating of 9 European countries, when the single currency hit fresh low at 126.22. Currently is under strong recovery above 127 level. This also triggered this reversal in the US dollar, and the gold is appreciating during the Asian session and the early hours of European session. From the Eurozone, another negative news coming as US rating agency Standard & Poor's cuts its credit rating for Eurozone's EFSF rescue fund yesterday, and Greece was under pressure to break a deadlock in debt swap talks if it is to avoid an unruly default. French finance minister said that there was no need to shore up the European Financial Stability Facility after S&P downgraded it by one notch to AA plus from AAA, echoing the view of Germany, the only major Eurozone member to retain a top-notch credit rating. S&P said in a statement, decision was all but inevitable following identical cuts 3 days earlier to the creditworthiness of France and Austria, two of the EFSF guarantors. Currently, the situation is still in the Eurozone quite gloomy, and as analysts see, the further negative action might be seen in the near future, according to the latest news. For today, a brief look at the calendar that is showing a quite busy day ahead of us, apart from data already released during the night from China, showing the GDP quarterly release of 8.9% growth compared to the previous third quarter at 9.1%, and more positive was yearly industrial production that showed growth by 12.8% compared to 12.4% previous release, and 12.3% forecast for today. Also, Chinese yearly retail sales grow in a better than expected figure. 18.1 was the release today compared to 17.2 forecast and 17.3 previous release. Still to come, much of data from UK starting at 9:30 GMT. Yearly inflation is expected to come at 4.2% compared to 4.8 previous month release, while RPI retail price index yearly is expected to come at 4.7%, which is today's forecast, compared to 5.2% previous month release. Core CPI from UK is forecasted at 3%, slightly lower than the previous release at 3.2%. Also, the Bank of England's Governor King is due to have a speech at 9:45 GMT. From the Europe, German zoo economic sentiment is due at 10 o'clock, and some improvement is seen as the forecast for today is minus 49.7 compared to a previous release at minus 53.8%. From Eurozone, also Eurozone CPI yearly is expected to stay unchanged at 2.8%, as well as core yearly CPI at 1.6% forecast for today and the previous release. Eurozone zoo economic sentiment forecast for today minus 48.7 compared to minus 54.1 previous month release. CB leading index from UK at the same time, 10 o'clock GMT. No forecast, minus 0.4% was the previous month release. Across the ocean at 13:30 GMT, US Empire State Manufacturing Index positive forecast at 10.8 compared to 9.5 previous release. And at 1400 GMT, the rate decision from Bank of Canada, as expected, the bank will likely stay pat with the 1% rate unchanged at 1%. After they release the statement after release of the interest rate decision, the statement will follow at the same time. That would be from today's calendar. Now we're going to take a look on the technicals and see the latest developments in the markets in past 24 hours. As we can see, the euro, after yesterday's consolidation under 127 level, after hitting a fresh low at 126.22, is breaking higher. It started during the Asian session, clearance of 50% Fibonacci retracement at about 127.50 zone of the latest down move from 128.77 to 126.22 is now looking for further extension higher. However, overbought hourly studies see scope, and there is already signs of exhaustion at this level, with the corrective pullback expected to hold above 20 days moving average currently at around 27 zone to maintain the near-term positive action and possibly extend higher. Break above 128.77, our key near-term resistance, is required to signal stronger recovery and to mark the temporary bottom at 126.22 and allow for a stronger recovery. However, the wider pictures and the larger time frames are still in the negative zone, and according to this, the current bounce is seen corrective and just as a selling opportunity as long as 128.77 stays intact. Break above 128.77 is, as I mentioned, to signal a stronger recovery. Otherwise, we might just see the scenario of posting a lower top and a fresh extension lower. The main downside target is at 126.22, last Friday's fresh low, ahead of key levels at 126.00 and 125.86, Fibonacci 76.4% of 118.75, 149.38%, and the break point at 125.86, low of 22nd of August 2010, loss of which might attract further weakness of Eurozone on the downside. Levels to come on the break of 125.86 is a low of 2009 at 124.55, low of 2008 at 123.31, 120 as the figure support, and the key longer term level at 118.75, low of 2010, posted the 1st of June 2010. As also daily outlook remains firmly bearish, the focus is still at the downside, with latest bouncing corrective. As long as 128.77 and 128.84, where is currently 20 days moving average on daily chart, stands, that actually maintains the latest weakness, is just seen as a selling opportunity and the correction ahead of a fresh leg lower. The British pound is also bouncing higher after hitting a low at 152.33, basically loss of the recent range floor at 153.60 and the key medium-term support at 152.71, low of 2011. Is looking for further extension lower, especially if we see the weekly chart where there is a strong support zone at around 153 that has been briefly taken as the pair extended to for 152.33, and this would likely open way for a fresh weakness and the test next significant level at 150 zone. For now, on the wider picture, also the studies are in the negative territory. Main barrier in the short term is at 155, and as long as holding below this level, the focus remains on the downside. On the very near term, break above main trend line resistance drawn from 156.68 high of 2012 and regain of over 50% of the Fibonacci retracement of the latest down leg from 155 to 152.33 is looking for a test of the next significant levels at 154 zone that marks Fibonacci 61.8% and 154.08 is the high of last Friday, above which would likely attract 155.00 for retest. Holding below 154 might risk a lower top and fresh extension lower as wider picture is still firmly in the bearish mode. Hourly studies are now gaining a positive tone. However, overbought conditions now looking for a pullback with the 153.50 offering initial support ahead of dynamic one at 153.37 currently 20 days moving average, and the reversal around this zone would keep the latest past 2 days a positive structure intact for a possible extension higher and test of next strong barrier at 154.00. Failure under 153.50 risks further extension lower. 153.00, 152.75 are strong supports ahead of key one of the near-term outlook at 152.33, and then a likely scenario of extension lower towards 150 zone in the short term. The dollar yen also lost traction after attempt at 77.00 yesterday failed, and the sharp reversal broke below the previous higher platform at 76.65. Currently to test our key support at 76.50-60 zone. Temporary support for now was found at 76.56, but risk remains at the downside. As we can see, loss of this key support would signal an end of the medium-term consolidation, post-intervention consolidation phase, and open way for a further extension lower. Upside is now firmly capped by initially 77 and 77.17 currently, where is the 90 days moving average that limited the recent action during the past 3 weeks. And only break here and 77.32 high of 6th of January would provide some relief. Otherwise, the likely scenario would be break below 76.50 and challenge 76.10, 76.00 ahead of record low at 75.56 posted on 31st of August 2011. Just to remind you again, a possibility of Bank of Japan intervening in this case is quite likely, but nothing yet confirmed. However, the risk is of losing 76.50. That might trigger an action from Japanese central bank. The dollar Swiss again upside rejection under 96 key barrier as the pair stalled at 95.96 on 9th of January, with the corrective pullback finding good support at strong support level at 94 zone. leaving a double bottom ahead of bounce higher. For now, the gains were limited at 95.73. Double attempt at this point failed, and subsequent reversal is now on the way towards next strong support, which is 94.70, the 61.8% retracement of the latest 94.04 and 95.73 ascent ahead of 93.50, below which would signal temporary top at 95.73, and look for test of our key near-term support at 94.00. Risk is on loss of 94. That might trigger delay the broader uptrend from a 70.67 record low, and look for a further reversal with the 93 low of 3rd of January 2012 and also yearly low to come in focus. On the daily outlook, the 20 days moving average at currently at 94.35 offers also the support, and that actually contained the previous dips at 94, and this is now acting as dynamic support for dollar Swiss, loss of which and the 94.00 would further delay the latest uptrend. As on the daily, seen on the daily, the outside looks a bit toppish, as several attempts higher failed to sustain gains. There was a brief break above 95.45 previous high that resulted in a fresh high at 95.93, but gains were limited under 96, our key barrier in the short term, and for now the risk remains on a test of 94, below which to, as I mentioned, delay the current bulls in favor of stronger correction. Break above 96 opens 97, ahead of 97.63 and 97.85, our upside targets in the short term. Commodities, gold is back to strength after finding good support yesterday at last Friday at 16.25, and regaining the previous high at 16.62, 16.67 seen so far, with the positive studies looking for a further extension higher, and just ahead of this is 61.8 Fibonacci retracement at around 1671, retracement of the latest down leg from 1763, that break of which and the trend line, main trend line from 1920 record high of gold to signal temporary bottom at 1522, and open way for a possible test of 1700 first, and then 1756, 63 our next targets. The hourly and 4-hour studies are positive. However, hourlies are already in the deep overbought territory and correcting lower. 20 days moving average at 1650 is offering now good support as dynamic support, while static ones are at close to it at 1647, and the reversal at above these levels is required to maintain the latest positive structure from 1625 and keep the upside in focus. Loss of 1646.45 would be risky for a further reversal and a possible retest of 1625. Crude oil February contract is in the positive near-term tone after finding ground at 97.69 last Friday. A break above previous break above $100 as a psychological barrier and previous high at 100.17 has so far extended the gains to 169, retracing between 50 and 61.8% of the latest down leg from 102.96. 61.8% retracement level is around $101, above which is to confirm the near-term bottom at 97. Still look for extension towards 102.96 and possibly 103.39 highs. On the daily outlook, the main bull trend line of 74.94 has so far contained the dips along with the 55 days moving average currently at 98.41, and while holding above these levels, positive structure of medium-term structure of 74.94 remains in play. However, the upside is still in a way toppish, as several attempts higher failed to break higher, being capped at 103.72, as the previous high of 103.35 was briefly exceeded at 103.72 ahead of another pullback. So further ranging might be seen, but holding above 98, above 99, which is the main bull trend line, and the 55 days moving average at 98.40 would keep the positive structure in play and keep the immediate focus at the upside on the daily chart.